Hello, Instar trainees. We're back again. This is the second video. The first video I had was looking at our Congressional Review Board dealing with Wall Street. And this particular one here, this one was done just 7 or 8 months or so ago. One of the biggest problems people don't understand is that our entire system is a really highly unregulated criminal system. Why do I say such a thing? Because the simple fact is we don't go after the CEOs. Now, this is a new video, and we will be seeing information about Bankman-Fried. They will go after him because he's outside of the banking system. However, if he was inside of the banking system, instead of running as a hedge fund out of Bahamas, probably A, wouldn't even heard about it, and B, he certainly wouldn't be up for the criminal charges. The SEC is very weak. It doesn't have any real regulations for dealing with our banks. And let's start with that first. $1 billion in fines and 35 cases since the beginning of 2021. Bank of America settled for $75 million based on allegations that it ripped off its customers. JP Morgan, another big bank from Wall Street with racial discrimination. Citibank agreed to refund $4.2 billion for overcharging credit cards. All this is on a normal basis. This is how they do business. Let's stop it right there. Over the last 2 decades, the 6 largest U.S. banks have been involved in 430 major legal actions, resulting in nearly $2 billion in fines and settlements. The biggest of them all, of course, and I've talked about it endlessly, is the 401k IRA plan. That plan has already cost the American public, from 1981, when they incited it, all the way up to 2020. For that time frame, somewhere in the neighborhood of about $16 trillion was put into it. And Wall Street conveniently has, every 7 years on a decade, some strange, artificially created downturn that ends up wiping out 38% of those accounts. And most people don't understand that when you lose 38%, you need 76% in order to get back. Most people, through their own ignorance and stupidity, think that if the market jumps back 40%, then they're back in the black again. They're not. They're still in the red and a long way up because they've lost so much money and they have to double it in order to get it back to zero again. But as you can see, the problem that we have here is we do nothing to these banking organizations. If they get themselves in a lot of trouble, we bail them out. That's my point here. So this is the first part of this video. I want you to see this because it's really important. The fact of the matter is you're doing banking with this. This is your Wall Street. And this Wall Street is destroying you. Literally. Moving on. Shock, breath, death, the precision of repeated law breaking by these banks to only meaningful and personal punishing executives will stop this Wall Street crime spree, and we never will. Sadly, but true. However, I think as we looked at this next video, people are beginning to come awake a little bit and begin to realize that, first of all, cryptocurrency was not an intelligent idea to begin with. And by it being a digital wallet, it can get lost very easily. They may extradite him back over, and they might get some more information about it, but the scale of the loss probably in the neighborhood of 100 billion. They just won't never tell you. They want us to believe that our banking systems are good. We have a better way at Instar Alliance. You can work with these other companies that aren't part of the banking industry that can offer you a lot safer and highly more profitable investments than dealing with the traditional Wall Street. Let's move on.
That is, if he's convicted of everything the US government has alleged. But it's not just his future that is now at stake. The fallout from the FTX meltdown has finally reached Congress. The US House Financial Services Committee has been listening to testimony about what happened. Its intent is to get to the bottom of what exactly went on with the world's second largest crypto exchange.
FTX misused an approximately $10 billion in customer funds and owes creditors at least $3 billion. Today, as many as 1 million people, many of whom are here in the United States, are locked out of their FTX accounts and may recover only a fraction of their hard-earned investments, if any at all.
Founder and former FTX CEO Sam Bankman-Fried hasn't been testifying to the panel, however. Instead, he's been dealing with an inquiry of his own. That's after his arrest in the Bahamas, where he's just been denied bail. A judge there said he's a flight risk ahead of a potential extradition to the US to face criminal charges. Those include multiple counts of securities fraud, wire fraud, conspiracy, money laundering, and violating campaign finance rules. If convicted, the maximum penalty would be 115 years behind bars. The timing, though, has raised questions coming just ahead of this congressional hearing. SBF had been expected to testify there, and lawmakers said they were frustrated they weren't able to get him under oath first.
Frankly, I look forward to getting his lies even on the record under oath. Nevertheless, the arrest of Sam Bankman-Fried is welcome news.
The man replacing SBF as FTX CEO John Ray III instead sat as the lone witness for the congressional hearing. He was crystal clear about what he believed was to blame.
FTX Group's collapse appears to stem from absolute concentration of control in the hands of a small group of grossly inexperienced and unsophisticated individuals. Failed to implement virtually any of the systems or controls that are necessary for a company entrusted with other people's money or assets.
Ray, who is a based lawyer who also managed the liquidation of Enron in 2001, said the FTX meltdown was a completely unique experience. He also testified that SBF transferred billions of dollars in FTX customer funds to his hedge fund, Alameda Research.
The operations of the FTX Group were not segregated. It was really operated as one company. As a result, there's no distinction virtually between the operations of the company and who controlled those operations.
I'm so deeply troubled to learn how common it was for Bankman-Fried and FTX employees to steal from the cookie jar of customer funds to finance their lavish lifestyle.
Ray said that the scope of the current investigation into FTX is enormous. It involves detailed tracing of transfers all the way back to the founding of FTX, and it also needs complicated technological efforts to try and find and track the company's crypto assets.
We're in the process of collecting or reviewing dozens of terabytes of documents and data, including billions of individual transactions. We're leveraging sophisticated technology and expertise to identify and trace additional transactions and assets.
While SBF didn't appear at the hearing, Forbes released what was a copy of his planned testimony. In it, SBF took shots at Ray's management and expressed regret over, quote, giving into pressure to file for bankruptcy. All of this came as the US Securities and Exchange Commission, the SEC, announced charges against SBF personally as well. Some lawmakers have already tried to blame the SEC boss Gary Gensler for missing what was really going on at FTX.
We know the Securities and Exchange Commission Chair Gensler's regulation by enforcement approach is not going to stop bad actors. Next year, I look forward to hearing from Mr. Gensler early and often. And we'll hear from him on how we can provide clarity on the application of our securities laws to trading platforms.
What laws?
He has failed to do.
The hearing is just the first part of Congress's investigation into FTX. The second part of that is going to happen next year.
Rest assured that this committee will not stop until we uncover the full truth behind the collapse of FTX.
The bigger concern for the rest of crypto, however, is how this continues to impact the sector and how it informs what regulators do next.
ongoing failures of crypto firms like TerraSD, Celsius, BlockFi, and most significantly FTX and Alameda Research only serves to strengthen the importance for Congress and the public to understand the harm caused to customers.
It has been a momentous 12 months for the crypto sector, and it continues to be right up until the end of the year. We at Forecast have been trying our best to cover everything that's been going on and bring you the analysis that's needed on these subjects. If you like any of the content that we've put out this year, please like it, please subscribe to it, and share it as well. We also want to hear your thoughts in the comments on our social media.
Well, that was quick and that was painful, but that's the reality that you live in. All that we're trying to do at Instar Alliance is to open your eyes and make you realize that when you see something being advertised as a good investment, it is not a good investment. I know wealthy people, I'm not counting myself, but I just know wealthy people, and they do not invest in things that you normally see on social media and on TV. They do their due diligence, they do their research, and they look for companies that don't advertise. The companies we work with don't advertise. If they advertise, then basically they would be overwhelmed by people who couldn't even inform an intelligent investment decision, bombarding their systems. They don't want that. They want smart investors, and they know smart investors are out there. And the ones that do create wealth that way are those smart investors, and they're the ones that they want to work with and do business with. So the lesson to this learning experience is please think before you invest. When you don't, and when you use social media, internet, and friends and relatives to try to make intelligent financial decisions, you're going to end up with these other millions of people who've just lost billions of dollars. Thank you for your time. Have a nice day.